Q2 2026 revenue is in at $31.6 billion.
Oh, wow.
Yeah, that is up 2.3% year over year right out of the gate. And adjusted earnings per share printed at 65 cents.
Which is a huge beat, honestly.
Massive. It's a 20.4% jump from the 54 cents we saw a year ago.
Right.
Free cash flow is sitting at $4.7 billion, and that's up from $4.4 billion last year. Plus, adjusted EBITDA came in at $12.3 billion, so a 5.2% year-over-year increase.
I mean, those are heavy, definitive numbers across the board. You're looking at a company that is aggressively beating its own internal drumbeat.
That is the perfect way to frame it. So for you listening to this, the retail investor trying to make sense of your portfolio, our mission for this deep dive today is to really unpack AT&T's so-called investment-led strategy.
Because you really have to look under the hood with a report like this.
Exactly. We need to see the physical mechanics of how they are engineering this top line and bottom line growth. But more importantly, we have to look at what they are intentionally destroying in the background to achieve it.
Yeah, you cannot analyze a 140-year-old telecom giant simply by looking at what they are building.
Right.
You have to understand the cost of what they are tearing down. I mean, it is a masterclass in structural transformation.
Well, let's start with what they are building. Moving straight from that $31.6 billion top-line revenue beat, we have to isolate the how.
Right.
And when you strip away all the noise in this report, this entire growth story is basically riding on the back of a single segment.
Advanced connectivity.
Advanced connectivity, that's it.
That is the absolute engine of the business right now. I mean, it is where the future of the company lives or dies.
And the scale of it is just staggering. So advanced connectivity segment revenue hit $28.6 billion for the quarter.
Right.
Which is up 4.1% year over year. But if you isolate just the service revenue within that bucket, it's $23.5 billion, up 5.1%.
And that distinction is so crucial.
Between total and service revenue.
Exactly. It tells you this growth isn't just like a temporary spike from selling people new iPhones or routing equipment.
Right. It's not hardware.
No, that $23.5 billion is recurring service revenue. It is the monthly subscription money that the market loves, because it's predictable, it compounds, and it just fundamentally drives the valuation of the vehicle.
And the profitability of that recurring revenue is what really jumps off the page to me. The EBITDA for advanced connectivity came in at $12.0 billion.
Which is huge.
It is. That's an 8.0% year-over-year increase. They managed to push their EBITDA margin for the segment to a very healthy 42.0%.
Yeah, and in telecom, squeezing 42 cents of operating profit out of every dollar is a massive operational victory.
But you don't get there without actual human beings paying the bills.
Right.
They pulled in over 1 million total net adds this quarter alone.
And we really have to unpack the composition of that 1 million, because in this industry, net adds can sometimes be a vanity metric.
Like just giving away free lines.
Yeah, exactly. If a company is just padding its numbers with low-margin prepaid connections or discounted tablets, the volume doesn't actually translate to cash flow.
Well, if you look at the breakdown here, you'll notice something striking. They pulled in 432,000 postpaid phones.
Okay.
And their postpaid phone churn was a microscopic 0.86%.
Wow.
Yeah, and churn is just industry speak for the percentage of people canceling their service.
Yeah.
So at 0.86%, fewer than 1 in 100 people are leaving. They're essentially building a roach motel for customers, you know.
A roach motel.
Yeah. People check in, but they simply do not check out.
That's a great way to put it. And that churn metric is arguably the most important number in a wireless operator's deck.
Because of acquisition costs?
Exactly. Customer acquisition cost is the silent killer in telecom. When your churn drops below 1%, it means you don't have to spend billions on television ads just to replace the people running out the back door.
Right, you're not just treading water.
Every new customer you add actually drops to the bottom line.
And then on the home internet side, they added 646,000 connections. That is split between 367,000 pure fiber connections and 279,000 fixed wireless connections.
Right, what they brand as AT&T Internet Air.
Exactly.
And that fixed wireless number serves a very specific strategic purpose. It is a defensive maneuver.
How so?
Well, they are using Internet Air to capture or hold on to the market in neighborhoods where they just haven't laid physical fiber yet.
Ah.
It keeps the customer inside the AT&T billing ecosystem until the fiber trucks finally arrive. But make no mistake, fiber is the end game.
Which brings us perfectly to the physical footprint. The report highlights they have now reached 38.6 million total fiber locations.
There's a massive footprint.
It is, but it is important to note for you listening that this number was heavily aided by their recent acquisition of Lumen's mass markets fiber business.
Right, that closed back in February.
Yep. And looking forward, they are tracking to hit 40 million fiber locations by the end of this year and a massive 60 million by 2030.
And this is where CEO John Stankey's broader strategy materializes into physical reality. I mean, fiber isn't just another product tier they offer.
It's the foundation.
It is the physical ground game. When you trench a street and run a glass cable directly into someone's living room, you are laying an infrastructural foundation that allows you to sell them everything else.
And this is exactly where the math gets really fascinating. In the report, management highlights a convergence rate of 42.5%.
That number is wild.
It is. That means 42.5% of households that have AT&T's advanced home internet also choose AT&T for their wireless mobile service.
Right.
When I look at this mechanism, I see a retail ecosystem trap. It functions exactly like a Prime membership for your digital life.
It really does.
Once they run that physical fiber cable into your house, acquiring you for their mobile network requires almost zero additional marketing spend.
Because the unit economics of convergence are incredible. If you already have the billing relationship, you have the routing hardware in their house and that localized brand trust.
Cross-selling is easy.
Exactly. Cross-selling a mobile family plan costs a fraction of what it takes to poach a customer away from a rival carrier.
But wait, I have to push back here. They are expanding into completely unfamiliar geographic territory right now.
Through the Lumen deal.
Exactly, specifically through that Lumen acquisition.
Yeah.
You can buy the physical cables from another company, sure, but you do not automatically buy brand loyalty along with them.
Right, that's true.
So is a 42.5% convergence rate actually sustainable as they push into these new regional markets? Like, are they going to hit a wall where consumers say, thanks for the fast home internet, but I'm keeping my old phone carrier?
Well, that is the multi-billion-dollar question regarding the limits of convergence.
Yeah.
But the bet management is making, and honestly what the current math is validating, is that owning the largest continuous fiber network in America gives them an unmatched structural advantage.
Just purely based on the tech.
Yes. The physical performance of fiber, its symmetrical upload and download speeds, is undeniably superior to legacy cable.
For sure.
So when a consumer experiences that level of reliability for their home, the friction to bundle their wireless service decreases significantly.
They just trust the network more.
Right. That infrastructural superiority is what is translating directly into that 42.5% attach rate. And more importantly for the investor looking at the stock, it explains the 350 basis point jump in operating income margin for this segment.
Oh, because they're doubling up.
Exactly. They're squeezing significantly more profit out of the exact same household footprint.
But those massive 42% margins in fiber aren't just coming from adding new customers. They're actually being subsidized by what AT&T is intentionally destroying in the background.
The legacy stuff.
Yeah. If advanced connectivity is the shiny new skyscraper they are building, we really have to pivot and look at the foundation they are actively imploding.
Right.
You cannot fully understand the margin expansion in fiber and 5G without understanding the intentional demolition of the legacy copper network.
Because it is the anchor currently weighing down their operations.
Heavily.
But cutting that chain is a painful, legally complex, and highly expensive process.
Painful is putting it mildly. The numbers in the legacy segment are an absolute bloodbath.
They really are.
Legacy revenues plummeted 25.9% year over year, down to $1.63 billion. And the profits fell even harder. Legacy EBITDA was down 45.5% to just $523 million.
And we have to emphasize this for anyone holding the stock who might panic seeing those massive drops.
We do.
This is not an accident. This is not AT&T losing market share to competitors in this specific space. This collapse is entirely by design.
They are actively forcing customers off the old tech. The report actually states that more than 85% of their wire centers are already approved to stop selling legacy services entirely.
Wow.
And it gets more aggressive. Over 30% of them are approved to completely discontinue providing those services by late 2026.
So they're just pulling the plug.
Literally, if you have an old copper-based landline or DSL service in those areas, they are shutting the lights off.
And people underestimate what a massive regulatory and operational undertaking this is.
Oh, the red tape alone.
Right, you can't just flip a switch and turn off a public utility. You have to file paperwork with public utility commissions, you have to get formal approval to shut these localized networks down, and you have to deal with the physical extraction.
It takes years.
But look at their long-term outlook for 2026 through 2028.
Mm-hmm.
They expect legacy revenue to decline by 20% or more in 2026 alone, and they boldly project it will be entirely immaterial by 2029.
Which brings me to a glaring, almost alarming detail buried in that long-term guidance. AT&T actually expects legacy EBITDA to turn completely negative after 2027.
Negative.
Yes, negative. They are literally going to run the segment at a total loss until they can substantially eliminate the direct costs of operating the copper network.
Wow.
I look at this dynamic and I call it the demolition tax. So my question to you is it dangerously risky for a telecom giant to intentionally operate a massive segment of its historical business at a loss for years, just to force a consumer transition?
Well, it is absolutely a valid risk to highlight, but you have to view the demolition tax within the broader operational reality. Maintaining a telecom network requires intense capital. You are paying for truck rolls, specialized union technicians, the maintenance of aging hardware, and entirely separate legacy billing software.
Right.
Right now, AT&T is running two parallel networks, the copper of the past and the fiber of the future.
Yeah, that's got to be expensive.
Running both is like a city trying to maintain a modern high-speed subway system while still being forced to feed and house horses for old streetcars.
That is a great analogy.
The cost of running both systems simultaneously is just bleeding them dry.
So they are choosing to take the acute financial hit right now to avoid bleeding out slowly over the next decade.
Precisely. By taking the hit on legacy today, they're positioning themselves to eliminate those massive dual network maintenance costs tomorrow.
Makes sense.
And we're already seeing the proof of this strategy working in real time. If you look closely at the report, there was a 10.8% drop in legacy operating expenses this quarter alone.
Oh, wow. So they're already saving money there.
Yes. That proves they are successfully stripping out the personnel and fulfillment costs associated with copper. It is a calculated, near-term margin drag designed to create long-term structural efficiency.
All right, so we have covered the operations, the growth engine on one side, and the demolition tax on the other. Now we need to transition to how this company is actually funding this dual reality.
Because it's not cheap.
No, not at all. Building millions of miles of fiber and painstakingly shutting down copper requires an immense amount of capital. How is AT&T managing its cash, its debt, and its rewards to you, the retail investor holding the shares?
Well, it's a capital-intensive game, and AT&T is playing it with very large chips.
Very large chips. They reported heavy ongoing capital investment of $6.1 billion just this quarter.
Just in one quarter.
Yep. And their forward guidance shows they plan to spend between $23 and $24 billion annually through 2028.
Right.
But the wild part of this financial equation is that despite spending that much money on infrastructure, their free cash flow is still climbing at an impressive rate.
Because the cash generation of a fiber business model, once the lines are actually laid and scaled, is formidable.
The margins open up.
Right. The maintenance capital required just drops off a cliff compared to the initial build-out.
And you see it in the numbers. They're projecting over $18 billion in free cash flow for 2026, over $19 billion for 2027, and over $21 billion for 2028.
Incredible cash generation.
Yeah, and with all that cash being thrown off, they're easily maintaining their $1.11 annualized dividend.
Right.
But the headline grabber, the thing that really caught the market's attention in this report, is the share repurchases. AT&T is accelerating its planned stock buybacks to approximately $10 billion for 2026 alone.
Huge.
And that is out of a $45 billion plus total return plan from 2026 to 2028.
Committing $10 billion to stock buybacks in a single year is a massive statement of intent from management.
It really is.
When a company reduces the total number of shares available, it artificially boosts the earnings per share, even if net income stays flat. It is a way to manufacture shareholder value while waiting for the fiber revenue to fully mature.
It is a massive statement, but for retail investors, there is a giant shadow hanging over that $10 billion celebration.
The debt.
They still have a mountain of debt. Net debt sits at $126.4 billion.
Which is one of the heaviest debt loads in corporate America. You really feel the gravitational pull of a number that large.
So with $126.4 billion in net debt sitting on the balance sheet, is lighting up $10 billion in stock buybacks this year actually the most prudent move?
That's the debate.
Right. Like, wouldn't it be far better to aggressively deleverage the company, especially in a macroeconomic environment where rates are just historically volatile?
You You are hitting on the classic corporate finance dilemma. Do you reward equity holders or do you secure the balance sheet?
Exactly.
But the dynamic here is that AT&T's cash engine is currently robust enough to attempt both. They aren't forcing themselves to choose one at the total expense of the other.
Because of the liquidity.
Yes, they ended the second quarter with $17.6 billion in cash and cash equivalents on hand. When you have that much sheer liquidity and your free cash flow is projected to expand from $18 billion to $21 billion over the next 3 years, you actually have the operational luxury to juggle all the obligations at once.
So they are attempting to appease every type of stakeholder simultaneously.
That is the strategy. They appease the income investors who demand yield by maintaining that $1.11 dividend.
Right.
They appease the growth investors and the broader market by accelerating the $10 billion in buybacks. And they appease the debt holders and the critical credit rating agencies with gradual, consistent debt paydowns from the remaining cash flow.
It's a delicate balancing act, though, and you have to assume that balance is highly sensitive to external shocks.
It absolutely is. And it's important to remember that macroeconomic factors still play a significant role in their leverage ratio, entirely independent of their operational excellence.
Like currency issues.
Exactly. For instance, in this quarter's report, management noted that foreign exchange impacts actually helped decrease the debt balance by $0.3 billion.
Wow. Okay.
So while the internal cash generation of the fiber network is strong, you, as an investor, have to remember that a $126 billion debt load is still highly sensitive to global macro breezes, like currency fluctuations.
That is a crucial point. I mean, a $300 million favor from foreign exchange rates is great for this quarter, but you cannot build a long-term balance sheet strategy hoping for favorable currency fluctuations.
No, you build a strategy on the predictable free cash flow coming from those converged fiber and wireless customers.
Right.
That is the bedrock of the entire enterprise.
So as we bring this deep dive to a close, we need to look beyond just the immediate rosy numbers of Q2 2026. Because a massive revenue beat and the shiny object of a $10 billion buyback can sometimes blind you to the longer-term structural shifts happening in the background.
Oh, there's always a ticking clock hidden in the footnotes of the guidance.
And we found a crucial one for you to monitor. Buried deep in management's long-term outlook, they casually noted that their net debt-to-adjusted EBITDA ratio will return to their 2.5x target. And this is a direct quote from the report, within approximately 3 years following the closing of its transaction with EchoStar.
That is a very carefully constructed sentence,
Highly constructed.
and it carries a massive amount of weight.
It does. This single line implies that the impending EchoStar deal is going to heavily impact their leverage timeline. They are essentially moving the goalposts for when they will hit that healthy 2.5x leverage ratio, and they are pinning it entirely on the EchoStar timeline.
Yeah.
So for the retail investors celebrating the $10 billion buyback today, you need to keep a very close eye on how the EchoStar absorption alters the balance sheet tomorrow. It is not just about paying down current debt, it is about how much new weight they are taking on and whether this cash engine can actually support it.
Because the demolition of the copper network clears space on the balance sheet, but massive acquisitions like EchoStar fill that space right back up.
The balance sheet is a living document, and it is about to undergo another massive transformation. Thank you for joining us as we unpacked AT&T's Q2 performance. For you, the retail investor, staying ahead of these underlying structural shifts is everything. Make sure to hit follow on the show for our daily earnings coverage so you can keep staying ahead of the markets.